property or a property of a trade or business. Okay, so it's a federal tax code. This is just my little disclaimer. You guys have my PowerPoint, but so as a qualified intermediary, we don't give tax advice. Yeah, token. But I can't give tax advice. You always have to go to your CPA, your tax, or your legal advisor. We don't give any tax or legal advice. We only help you with the IRS guidelines. Yes, sir.
And I'm sorry, I'm pretty literal on the 1031 tax exchanges. Does it also apply towards your own primary residence?
No, it does not.
Did not know that.
Investment property. Or property of a trade or a business. This is our outline. Today I won't go through it because we're doing this whole class today. Okay, actual receipt. Actual receipt is what it sounds like. When you are at closing, you receive your funds, that's the actual receipt. Versus constructive receipt. Brian closes today around like 4:30 and realizes, oh wow, I'm gonna have to pay a lot of taxes. But I didn't receive the funds. So can I still do a 1031 exchange? The funds are still at the title company. So he calls me up, Cindy, I have a 1031 exchange for you. But we closed this afternoon, but I didn't touch the money yet. Can I still do the 1031 exchange? The answer is, Brian would love to help you, but it's too late to do 1031 exchange because you have a constructive receipt. In order to do a 1031 exchange, it has to be before you close. Okay, so once buyer and seller signs the docs, you've closed. Okay, regardless if you receive the money or not, you're a constructive receipt. You're entitled to the proceeds, you're entitled to the funds, and the buyer's entitled to the property. So it's too late to do a 1031 exchange. Typically, when I open an exchange, that's when I have a contract. I get a contract. That's when I open up the exchange file. But however, I do get calls, from the title company. Hey, Cindy, I have a client. They realize it's going to be it's an investment property, and they want to buy another property. When we do the 1031 exchange, we're at the closing table. That's when you kind of stop everything, tell your escrow officer. Your escrow officer is not going to be the happiest person, but you become the hero, okay? You call me, and then you're going to go to lunch and send me all the docs, and I can get you docs within an hour. But I don't market myself to do that in an hour just because we literally stop the whole company. We're nationwide. We're a leading national qualified intermediary. I literally stop the company and get you in there. So that can happen. So we don't charge extra for rushes, but generally, if you know coming, this better be prepared than the last minute, right? So has to be before you close, okay? If you're not in constructive receipt. Boot is a term you do hear quite often, okay? Boot means non-like kind. I would say boot is kind of like money received. It means receive money that's not like kind. So anything that, let's say, for instance, boot is going to be taxable. So let's say you have a property, but you want to take out money for improvements. You want to, fix it up. Well, that's not like kind. There's two types of boots, actually. There's a cash boot, and there is a mortgage boot. And you don't have to do a full tax deferral. So let's say I sold a property for $500,000. That's gone for a long time. $500,000, but I don't want to put my proceeds, all my money, into the next property. So I'm only going to defer. I'm going to put $400,000 in my next property. I'm going to take $100,000 cash. I'm going to pay taxes on that $100,000, and then pay taxes on it. That $100,000 is considered my cash boot. Okay, so it could be whatever. It could be that cash boot is going to be money used for my repairs, for my improvements, because it's after tax money. It's going to be tax money. Or let's say I just want to buy a nice fancy car, or just spend it, or pay down other debt, pay down my homestead, my loan. You're going to take that out of your cash boot, the money you receive at closing. Versus mortgage boot. That's considered debt relief. Okay? So for a full tax deferral, you want to spend the net proceeds, basically your sales price minus your cost of sale, which is going to be your realtor fees, your title fees, or let's say it's an attorney fees that's used to close for the closing. It's the cost to sell the property, okay? Which is going to be your net proceeds, and also you have to reinvest the same or greater debt, okay? Because if you have less debt, the IRS considers that a mortgage due. It's less debt. IRS goes, Brian, you owed $200,000 on this property, and now you owe $150,000. What happened to the $50,000? You pocket it. So you have to replace the debt. So therefore, I sold a property for $500,000. $200,000 is the note that got paid off at closing. So technically, as a qualified intermediary, I'm only holding roughly around $200,000, like just about $300,000 minus the cost of sale, right? But on your next property that you're buying, you're still purchasing a property that's around that 480. I don't know what closing cost is going to be, but let's say the net number is $500,000. You're still buying a property that's $500,000. My $300,000 is used to purchase. Is for cash, but you still need a loan, another one to replace that debt. So the debt needs to be replaced. Think of it as this. It's not your money, but it's someone's money. Ours goes, I don't care whose money it is, but that money was there, you need to replace it. So whether you replace it with cash or with another loan, but that debt needs to be replaced. If not, it's considered a mortgage debt.
And
Or a mortgage boot.
that's the original amount of the loan, right?
It's the current payoff. It's the current payoff. So another thing I mentioned, well, I don't really mention in my classes, but let's say it's all cash. My property was all $500,000, all cash. Okay, my net proceeds was all cash. I bought another property that was $500,000, paid cash. I'm going to refinance that and pull the equity out. So I put debt on it. Once I sell that and buy another property, I need to still match that debt on the next property, because if not, there'll be a mortgage due. So any debt needs to still be replaced. Make sense? We're good? Okay. So let's see. Cash direct deeding. Property is going to be directly deeded from buyer to seller, seller to buyer. Okay. We're not on the deed. You'll see us as on the HUD statement. So it'll show asset preservation as qualified intermediary. For GAM. We're not on the deed unless it's going to be sequential deeding. The sequential deeding is going to be on our, basically our more complicated exchanges where we have to part title, we have to take title to the property. And those are going to be on our more complicated exchanges. But most of the time, it's going to be directly deeded from buyer to seller. You don't see us on the deed. The client is the exchanger, the investor, and most importantly to the IRS is the taxpayer.
Oh, yeah.
And so I stress this, it's who is the taxpayer? Who is the taxable owner on the property? Okay, Brian's name is on the title on the sale. His wife is not on the contract. But who's the taxable owner? Even though it's just Brian's name on it. Taxes for community property, right? Do you file taxes jointly? Even if you bought the property without your, for one reason or whatever, if you bought the property without your spouse, you still file joint taxes, even though your name is on the property. But does the IRS recognize as you as the individual party that owns the property, or you and your spouse? Right? Also, taxable owner, I create a partnership. Okay, now typically if I own the property under myself, I file my personal taxes to my social security number, right? The IRS sees us as numbers, so it's under my social security number that owns this property. But I created a partnership. I joined partners, what's your name? Karen and I are partners. And so we don't own the property. we established this partnership now, we created a new tax ID, this entity, this LLC. That is the taxpayer that owns the property. So to the IRS, it's all about who's the taxable owner. I don't own the property, but this partnership owns the property. So it's about who owns the property. We entered into an exchange agreement with the qualified intermediary. I'm the qualified intermediary. We're also known as the facilitator or the accommodator. And you have an exchange period of 180 days to complete your exchange. That's from the time you sell your relinquished property. The property that you're selling is your relinquished property. That's your down leg or your phase one of the exchange. So you have 180 days from the time you close on your relinquished property to close on the new property, which is your replacement property. The replacement property was also phase two of the exchange or the up leg. Yes.
Isn't there an amount of time before you have to identify another
Correct.
property?
So in your exchange period, you have an identification period of 45 days. So in the 180 days, the identification period is within the first 45 days of the 180 days. It's inclusive. So you have to identify what you're going to buy. The IRS does that because they don't want to make it too easy, right? Because the IRS needs tax dollars, right, for our programs. And so we can't just feel like buying another property like, a year later and defer our taxes. So they have to they put some rules on it, right? They give you some rules to identify and some rules, your time limit. So you have to identify within 45 days what you're going to buy that you're considering, because you don't have to be under contract. It's just what you're considering. So are you in your 45 days right now?
Well, that's what I was just thinking, because you were saying the exchange period is 180 days from the first closing.
Correct.
So I haven't closed yet. We're under contract, but we
Okay,
haven't
you
closed.
haven't closed on the relinquished
So that
yet.
makes me feel a lot better. I was getting kind of nervous.
No, you're not. I know a lot of people get nervous. Yes, sir.
Is there a certain amount of properties that you can identify?
Yes, there's some rules to it, and I'll explain some of the rules. Most common is 3 properties, but there's 3 rules that you can use. You're going to use one of the 3 rules.
And in the identification period, those 45 days, what, for example, if I put an exact, it has to be an exact property, not just any property.
Correct.
So I put it, but then it doesn't go through. If I run out of my 45 days without being under contract already, what happens?
So if you don't identify any properties within your 45-day period, then you don't have an exchange, right?
But I identified, but then it just didn't go through.
Yeah, so you have 180 days to close on those properties, so you get your money back on day 181, and you pay your taxes on it.
Can I, within the 45 days, exchange those addresses? Like, okay,
If
this
you're
is not
within-
working.
If you're within your 45 days, you can always revoke your properties, what you identified, and re-identify, as long as you're within the 45 days.
So it has to be under contract within the 45.
It doesn't have to get under contract. You're just identifying, you're just listing addresses as possibilities of properties I'm going to buy. But in order to complete your exchange, it's going to be one of those properties that's on this list.
And if I come on day 60 with another property that I am already like under contract, here you go, but it's 60 days and it was not one of the identified ones.
Yeah, so if you come with day 60, it's like, well, yeah, day 181 will give you your money back, and then you can pay your new property with after-tax money.
So they don't have.
It's going to be after-tax money, so, yeah.
What happens if you identify 3 properties and this is something I was going to actually call you and ask you, but what happens if you identify a property in 45 days, but you don't have it under contract?
Mhm.
And then by the time you're ready to put it under contract, it's not longer available, which is a very rare scenario right now.
Yes. Well, hopefully you identify property 2, property 3 as your backup
Yeah.
properties. Yes.
Is there a maximum number of properties that can be relinquished to purchase one replacement?
Yeah, you can do as many as you want. And then you can also vice versa. So you can sell one property and buy multiple properties. or sell multiple properties, buy one property. So for example, there's a lot of land here. I get a lot of clients for a lot of land, so they're gonna sell a tract of land and buy different rent homes so they can cash flow. So let's say they're gonna sell that piece of land, buy four homes,
Sounds familiar.
right? Or let's say they have 4 homes, but hey, I wanna start investing in multifamily, a 4-plex apartment building. So you can do multiple.
And how many properties can you put under the identification period time?
So there's
Is
a
there a
couple of
maximum?
rules, but the most common rule is the 3 property rule. So I'll go over the other rules as well. Like kind property, you're going to charge for like kind. So remember what I just mentioned from your land to your rent homes, or a bunch of single-family rent homes to an apartment building. Those are all like kind. So remember to mention the taxes for investment property held for investment, as long as it's not your home. And it can't be flipped property. It's got to be a buy and hold or investment property. So it could go from land, rent homes, single family homes, commercial, oil and gas, mineral rights. Those are all considered like kind. Easements. Leases that are over 30 years is considered property. It's whatever is the state. So like for instance, there's also air rights, water rights, certain states. In New York, you've got your air rights. If you've got a building that's like 15 stories, you have the right to build another 5 stories on top of that. That's considered real property. They can sell that right and buy single-family home. So those are all considered lifetime.
What's the hold period?
The holding period? That's a good question.
minimum?
That's an early question. There's no holding period. Ours does not have a holding period.
So when you said no flipping, so I can buy something, sold it this January, buy something this month, and turn around and flip that again by the end of the year?
But there's no flipping.
So that's what I mean, how long do I have to hold it for it not to be counted as flipping?
Your intentions has to be a buy and hold.
How do you establish that?
How does
What's your
IRS
name?
prove it?
What's your name?
Swap.
SwapNet. Well, I mean, it's the IRS. They know everything.
You don't want to mess with them, I can tell you.
Right? It's not 1980, it would be harder to prove, right? Today, technology, they can look at your MLS, they can see how long you've held the property for, and SwapNet. I mean, it looks like you flipped the property. What, do you have substantial facts to show that you bought it as an investment property for a buy and hold? If you do, prove it.
Maybe lease
And then
it
what-
for a year, would that
what
include
makes it back on the market? Yeah.
Or have you even tried to lease it, maybe?
I'm gonna go through that.
Yeah,
You
right.
have a good question. It's usually a little bit further into my thoughts. And then, okay. I think I went through everything. Okay. So, do you remember the movie The Perfect Storm with Mark Wahlberg? 3 storms that collided became this massive storm. Well, we're in our massive storm right now. Right? At 1031 exchanges. The past decade, and even right now, I'm telling you, I'm slammed right now on exchanges. It's such a niche market, but I'm pretty darn busy. So, why? Because taxes are higher. Capital gain taxes went up over the years. There's the net investment income tax that was added. That's a 3.8% tax. Our market is strong. It's very rare that you buy property and then it depreciates in value, right? So nationally, our residential market and our commercial market has been pretty steady or with growth. So if you've held property for such a long time, well, some investors don't want to sell because what's the motivation? I'm going to get hit with a higher tax bill. So this gives them a reason to sell. It relieves the tax burden if they were to sell the property. Now there's 4 components that you're going to pay taxes on, or 4 components that you would defer. Okay? Your depreciation recapture tax is 25%. So on structures, your rent homes, your investment property, there's the wear and tear of the building. right? Your CPA is gonna probably take the depreciation on the wear and tear of the structure on the property. And so whatever you depreciate over the years is taxed back at 25%. Your capital gains taxes is gonna be 15 or 20%, depending on your income bracket. And then your net investment income tax is gonna be 3.8% tax, depending on your income bracket. And you have state income tax between 0 and 13.3%. California is on the higher side, so 13.3%. We are in the great state of Texas. We don't have a state income tax. Not Texas. But also remember, we are one of the 50 states. We are one of 7 states that do not have the state income tax, which means the other 43 states do. So when you have a client that's from out of state, that's something that they're also deferring. Or let's say if you, even if they're a resident here, but they have a property from out of state that has the same income tax, that's something that they're probably deferring as well. I didn't know this was slides, but do you guys know how to calculate your gains? Your gains is basically your sales price minus your net adjusted basis. Your basis is what you put into your property, okay? The net adjusted basis. And to calculate the net adjusted basis is your original price that you bought the property plus your improvements minus your depreciation is your net adjusted basis. And then you take your sales price that you're buying your new the sales price that you're selling your property minus the net adjusted basis is your gain. That's why you have my business card. That's right.
That's why it says contact the receipt.
Guidelines on how to calculate, but I can't tell anyone like, I don't know what your taxes are, but this general number, speak hypothetical numbers, right? Your capital gains is 20%. If you're a single filer, you make over 441, 550. Okay, of income. If you're married and you make over 496, 600, you're taxed at the 20% tax bracket. Below that threshold, you're taxed at 15%. You notice the difference between these two numbers? You're penalized if you're married, right? It's like, is that 5% worth it? And then if you're a joint filer and you make below 80,000, let's say if you're retired, you have no income. If you make below 80,000, or if you're a single filer and you make below 40,000, you don't have a capital gain tax. Now, the net investment income tax is also known as the Obamacare tax, the Medicare surcharge tax. That came from the Healthcare Reconciliation Act in 2010. And so basically, if you're a single file and if you make over 200,000, you get an additional 3.8% tax. If you're a married couple, if you make over 250,000 as a married couple, you get this 3.8% tax. What this tax is on unearned income. Okay, money that you've made without physically working for it. Your retirement, your dividend, your stocks, your capital gain, that's money that you made just sitting there where you're not physically, it's unearned, didn't really earn it, it just made money by itself.
Let me ask a question real quick. So, here we go, 250,000 for married couples filing jointly. It seems almost like it'd be who, even on the last one, to file separately.
So many other
I
tax issues out.
would refer you back to your CPA. Or if you're married, you may have some certain exemptions as well if you were married as well, so you would have to
Weigh them out.
weigh it out, yeah.
I find it ironic that the IRS is profiting without work on money that we earn without work.
How about that?
You didn't work hard for it, so we can make
Well,
some.
Yeah.
You need to prove that you
You
did the
got
work.
it free, so we're gonna get
Yeah.
it free.
This tax code has been around
Goes
since
easy, goes easy.
1921. He went through 100 years anniversary of 1031 exchanges.
Wow.
So it is in the proposal. Biden has proposed when he was under election to get rid of it, but this tax code hits the 100-year anniversary. Is it going to go away?
I don't think.
I don't know. I don't have an answer.
Same reason why the
So
toll. roads
therefore,
aren't
this is
away.
why I'm busy. Do it while you can.
While you're busy.
If not, it's going to change. However, for those that do ask me about this, you know, the 1031 exchange, it helps our economy. You know, a lot of people would lose jobs or less deals in the pipeline, right? Investors have no reason to sell because there's a higher tax. So, you know, if your investors aren't selling your real estate, there's no real estate to sell, your market doesn't appreciate as much. Goes down to your realtors, your brokers, your title company, your lenders, your handyman, your lawnmower. I mean, it affects a lot of jobs if we get rid of this. So hopefully, it stays around. But, you know, we spend our time educating the Democrats a lot on how positive it is for the economy. Now, as an investor, what are your options? Your options are to hold the property, sell, or do a 1031 exchange. And plenty of people hold. That's how you gain your property because you held the property, right? But as you guys are real estate professionals, real estate is cyclical. We're in a weird cycle right now, the past few years, right? We're always in a cycle. But, you know, it's their choice. Sometimes there's certain periods of the cycle where it's better to sell and better to hold. You know, sometimes it's with job opportunities, right? Like let's say in Detroit, there's no jobs there, so is the real estate appreciating as fast as another area that has a lot of jobs? So it depends, right? And it's fine to hold. The investor can also sell and pay their taxes. Nothing wrong with that. However, the question is, what are they going to do with the proceeds? After that, are you going to reinvest or is it just going to sit in your bank?
Hopefully not sitting in the back.
Okay. Now, if you're going to reinvest, can you get the same return on investment if you reinvested just after-tax money versus doing a 1031 exchange? It's possible, but it's hard. Let's say I sold multiple properties. Let's say I netted out, my net proceeds are $1 million. I've netted a couple properties outside the state, I'm in a higher tax bracket. Let's say I'm being taxed for about 35% after my depreciation recapture, I'm at 20% tax, and all that. I pay tax on $1 million. I'm paying, almost saying $350,000 in taxes. So I'm going to reinvest $650,000 in another business, versus I could have reinvested $1 million in cash flowing property. Can I achieve the same return on investment with my $650,000 investment versus my $1 million? It's possible, but it's hard. Okay, but let's say if I just didn't know, Brian didn't tell me he's going to do a 1031 exchange, you know. I reinvested $650,000 in real estate anyway, versus $1 million. More buying power at $1 million. I have a better property. And let's say I'm growing my real estate empire, guys. I'm very aggressive. I've got a lot of dreams. I've got expensive tastes. I'm going to leverage. I want a whole real estate empire. I'm going to leverage it. I'm going to put $650,000 as my loan, my down payment. Same 5% loan to value. So therefore, my buying power is $2.6 million. But if I had $1 million and leveraged that, my buying power is $4 million. 2.6 to $4 million. That's a lot of real estate. I can go from a couple houses to a lot of commercial. Yes, sir.
Why not just refinance the property and buy that with the money you pull from a refinance? Then you don't have to pay taxes.
You can, but you're still going to do a 1031 exchange. You can.
Correct.
Absolutely.
Correct, but if you refinance your property and buy, you own two properties.
Mm-hmm.
If you
Well,
sell it, you own one.
well, here's the thing. if you still own your property, you're gonna refinance, put debt on it, okay? And then you're selling it, you're paying off that loan, you still have to rematch that debt, you have to replace that debt. So you're paying off another loan, right? There's cost in your mortgage now. So like you might as well just sell that property and get a new loan, right?
It depends on the quality of the person.
Yeah, that's just strategy. So this whole thing is strategy on how you work that, right? So yeah, so some people, they don't want to pay the taxes, but they want the cash. They'll do the 1031 exchange, buy the property for cash, refinance to pull the cash so they can just spend it or whatever they want. It's part of it. Everyone has a different strategy. Yes.
Can you use multiple LLCs on a 1031 to purchase, for example, residential, I've got 4
As long as
LLCs
it's
to buy one commercial.
as long as you did it under a disregarded LLC. A disregarded LLC is like a shell company, a pass-through company, where you file your personal taxes for the LLC. I don't receive K-1s for it. On a LLC that I receive K-1s, it's treated as a partnership. That's a different taxpayer. Remember I mentioned earlier, who's the taxable owner of the property? So if you file personal taxes on this LLC, personal taxes with the Schedule C, IRS looks at that, it trickles down to your social security number. So you're the same taxpayer as this LLC, and if you create a different LLC, it still trickles down to your social security. It's the same, so you can go from one LLC to another. But, hey, Karen and I created another LLC that's a partnership. You cannot trade into that. That's a different taxpayer. So it's got to stay within the same taxpayer.
So if you have an investment property, sell that investment property and buy a second home, is that 1031 exchange?
No.
No. Even if you still have your primary
Correct.
residence?
It's not an investment property. You're not leasing it out. But
My friend did it
But-
for a ranch.
I have a way around it.
Good, that's what I want to know.
It's called through the vacation home. There's some criteria to go around it. It's in one of my slides there. I'll
Okay,
talk
oh,
about it.
awesome, okay, perfect.
So back to I get off, sorry, this might take over an hour because y'all are a fun group. Another reason why you want to do the 1031 exchange. Okay, so why do you want to do a 1031 exchange? Why? Defer taxes, because who wants to pay taxes? 2 is more buying power. The third reason is more estate planning. Because when you inherit property, you get a step up in basis. So when I inherit property, it goes from the day I receive the property. Anything past that, I don't get. So when I say step up in basis, here's an example. Hey, I have a property A. So by the way, this 1031 exchange is a tax deferral, not a tax exemption, okay? It defers, it follows you. So the Uncle Sam,
$80,000.
so Uncle Sam is in love with me, okay? He's following me around. I've got property A, investment property. I'm going to sell it. I'm going to do a 1031 exchange for property B. Okay? Uncle Sam's following me. Is there money there? I'm like, no. I'm not going to give you any money. I'm going to sell property B and do a 1031 exchange for property C. If I sell property C and I don't do a 1031 exchange, well, guess who's following me? Uncle Sam is following me. He's stalking me. He's in love with me. And he's waiting for me, because if I sell property C, he's going to go from, I want my tax for property C, B, and A.
He wants tax for the 3?
Correct. It's a tax deferral, not a tax relief.
But I thought that they would only collect on the last sale.
No. It's a tax deferral, you defer property A, B, and C.
And then you die and you leave it to the people after you to
So
take care of it.
yeah, so I just died. Let's say I bought my last property, my gain for it was $500,000. I died at $1 million. Let's pretend I have another, I don't know, 40 years. I don't know if I want to live past 90. Let's say I die and the property's worth $1 million, and my daughter is going to inherit it. Okay? Guess what? Uncle Sam is only in love with me, my daughter's too young for him. He doesn't care about my daughter. So therefore, the taxes on property A from 500 to $1 million, property B, and the taxes, the capital gain for property A is all gone. I'm gone, I died. So it's a potentially permanent deferral. So my daughter Avery, she inherits the property at $1 million. If she holds on to that property for another 10 years and that property appreciates from $1 million to 1.2, well, she got her own Uncle Sam stalker. She got a new stalker, okay? So she's responsible for her own gain. But the gain that I've gotten from property C, the $500,000 gain, the gain from property B, the property A, did vanish. Because my daughter didn't inherit any of that gain.
Because it's tied to your social, so your social dies with
Yeah.
you,
you
so
just
they
get
have nobody
you
to
get
come
step
in.
up and basically, this is not a taxing, it's a inheritance thing, right? Yes.
Okay, so let's say you have two partners in an LLC, they get K1s, one's 50, one's 80.
Mhm.
This is a real life, because, okay. So, my father, 80 years old, passes away in 50 years.
Mhm.
I inherit.
Mhm.
Does the tax stay with the LLC because it's K1s, and therefore I'm now part of the LLC and have the tax doable, but then the LLC never closes because his son inherits and this goes forever? Or am I taxable because it's by a social security number?
You have a special case, talk to your CPA. Because did you inherit the LLC, did you inherit the property as separate property?
It'd be the LLC.
You inherit the LLC. So I would probably talk to your CPA on that, because it's that taxpayer that has that.
It's all about
Yeah.
the number that it's attached to, really.
Yeah,
It's-
you inherit that LLC, but, so you didn't inherit real estate. Okay, you inherit a partnership.
Okay, so in your example, your daughter takes the hit on the 200,000 gain, but nothing else.
Yeah,
Is that what I'm
correct.
understanding?
Correct. But if she does a 1031 exchange,
Right.
right,
I'm saying if she sold
It's
it
still
within her
correct.
lifetime.
correct. So this is a potentially permanent deferral. Now, don't gift your children, I know you love your children, or some of us love their children, we have favorite ones. If you gift your child, you don't get to step up in basis. Had a client, so when you inherit the property, you get to step up in basis. Basis is your investment. So basically, the value that I bought the property at 500,000, it gets bumped up to $1 million. So my daughter inherits it at $1 million. So that's called a step up in basis, right? Because when I bought the property, I bought it for 500,000. That's my basis. You got to step up in basis. Now, when you gift your property to your children, you don't get a step up in basis. So I have a client that her mother had a ranch and wanted her to enjoy the ranch, and says, daughter, I gift you this ranch. I want you to enjoy it now, then later. It's going to go to you anyway. So she's on this ranch. The mother's owned this ranch since the 1950s, property in the family. She gifted her daughter in 2012, the ranch. And unfortunately, her mother died probably 6 to 9 months later. The daughter held on to the ranch for 3 years and sold it in 2015. CPA goes, I know your mother meant well, but if you inherited the property in 2012, your gain is only for 3 years, but since it was gifted, your capital gain is from 1950 to 2015. So she did a 1031 exchange to defer all those taxes. Unless I think the inheritance rule right now is probably around about 11 million. If they're inheriting 11 million, I don't feel so bad rated. So it's estate planning. Yes.
Is there another exit strategy that people have, or is that kind of the most common thing?
Well, talk to your CPA, because I'm just a 1031 exchange expert. So there could be other ways to defer taxes, but as far as real estate, I get a lot of referrals from CPAs, on real estate, but, if you have gain from like stocks and all that stuff, the CPAs may have a different way, strategy to help you with the gain, but as far as real estate, this is probably, this tax code's been around for a very long time, so I do get a lot of referrals from CPAs.
So with Congress are trying to get rid of the step-up basis, doing an inheritance and then having them go through a 1031 exchange is probably the thing that you want to do.
Yeah.
right?
If anybody's inheriting, it's good to look at the 1031 exchange just in case. I think this would be the advice.
Okay.
Always talk to your CPA, and taxes change, because that inheritance thing I'm talking about, like where you're being taxed on an inheritance tax, recently it was like 5.5 million, and it moved up to 11 million. So tax codes change all the time, so always, if I cannot express it, I'm expressing it now. Get it at CPA. Okay, and then you can always do a 1031 exchange, and by the way, you don't have to do full tax deferral. You can always do people do partial deferrals all the time. You want to pay down debt, you just don't include the whole amount, or let's say I sold a property for $1 million, ended up finding a property with the market's kind of hard. I bought a property that's $900,000 less. So towards the end of the exchange, you get the money back. That's your cash pay tax on it. You bought short versus bought something more. So this is the tax code. No gain or loss should be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind which is to be held either for productive use in a trade or business or for investment. Run-on sentence, right?
A little bit.
I don't always get that in one breath. But I want to point out this. No gain or loss shall be recognized. So this is non-recognition treatment. So the IRS uses tax code to manipulate, to drive the economy, right? So the IRS thinks that your investment property, it contributes to your economy. Because it is an investment property, it gives a place for someone to live or a business to operate their business. There could have been a mortgage, the lender, the maintenance people, the management company. It drives business, right, to your economy. Now, if you sell your investment property and keep the money for yourself, IRS goes, well, we're going to recognize that you profited. That's your capital gain. We're going to tax you. But hey, if you reinvest all that money into another investment property, that's money back that goes back into our economy. How to replace that same debt, right? So my new lender, their appraiser has a job or has a new deal. The environmental company, when it's commercial property, environmental, the phase one, whatever, the realtor, the broker, Cindy has a job. So all that new investment, basically, it's money back into our economy. So therefore, we're not going to recognize that you profited. We're not going to recognize that you have a gain. So this is non-recognition treatment. So, the code, property of a trade or business, so even if, let's say Keller Williams owns this building here, this is their trade or business. Or let's say even if you have a commercial client that, let's say, owns a restaurant, they bought the building, that's a trade or business, right? And like kind is going to be a broad term because that's technically what like kind is, a property of a trade or business or a property of for investment. So you got to trade it for another property of a trade or business or investment. You can't be your home. Exceptions. What can you not? What's not included? Stock and trade or other property held primarily for sale. That's your developer. Okay, let's say it's your 1-hour homes. Their inventory homes, that's their stock. That's their stock and their trade. So their intent is to buy a property, develop it, and to sell. The key word is to sell. So other property held primarily for sale. Their intent is to sell once they develop it. Your house flippers. Your intent is to buy the property, fix it up, and then sell. Your intent is to sell, not to hold for business or investment, but to sell. So you cannot, no developing, builders can't do it, house flippers cannot do it. Stock laws, interest in partnership. Your interest in the partnership, I can't sell my property and buy your interest with your LLC. Not gonna work, because I'm selling real property to, it's gotta go real property to real property, not real property to an interest in a partnership. Now, how does the IRS know, if it's all about intent, how does the IRS know? If I had bought the property with the intention of flipping it or putting it for investment. I mean, I'm a woman, I change my mind, I don't even know I change my mind about what to eat for lunch, right? Oh, it's all about intent. But I said earlier, well, IRS goes, prove it. What do I have to show to prove? So Brian has a couple properties and says, well, Mr. IRS, Uncle Sam, look, I have other properties that I've held for business. These are my tax statements. I've held this property, I've got renters, okay? And then I bought this one house right here, right before COVID hit, trying to lease it out. Look, this is my MLS listing. Two people looked at it, credit wasn't good, or they couldn't afford it, was not leasable. I had an opportunity to sell the property. Even though I've only held it for 8 months, but I sold the property. Maybe, it's convincible, right? That says, they can look at the frequency of the community of sales. You know, he's an investor, he's typically an investor, so does it look like he bought the property with an intent to hold for business, and then COVID happened? Life changes, so he had to change his mind. But Karen here, you must make fun of Karen's. So Karen, and I upgraded that baby. So Karen has like 4 other houses that she flipped, okay? And she's on this, and then she flipped another one. You know what? I'm getting tired of paying short-term taxes, short-term capital taxes. I'm gonna wing it. I'm gonna try selling. IRS goes, Karen, what do you have to prove? Because look at your history. You know, we see the MLS, we see you're a real estate professional, you know what you're doing. It looks like when you see a good flip, we think that you know what a good flip is. It looks like you flipped it. Guys, guess what? Karen just created tax fraud. That's tax evasion.
She's such a
Did not-
bad girl.
She's just a rebel. That's a felony. That's a felony. That's a felony. So what happens if she gets caught and courts do not send her? That's a felony. You know, you gotta pay back your capital gains and there's penalties.
Lawyer fees.
Karen looks good in orange. I may not look good in orange. Yeah, so if anyone here is from the IRS, don't do it, tax fraud. All right, okay, partnerships. So we were just talking about partnerships just now, that any entity can do the 1031 exchange partnerships. Coca-Cola, different trusts, REITs, individually, partnerships. But let's say we all enter a partnership and own the property together. We hold for 5 years and we sell it. What are the chances that we're gonna want to all go into the next building together? Rare, right? Because we all have different lives, and we want to do different things. But how do we do a 1031 exchange? Because the LLC, the corporation, the partnership owns the property. I only own an interest in the partnership, not the real property. In order to do that, there is a way, the common way to do it, a lot of people will do what we call a drop and swap. You drop out of the partnership and then become a tenant income owner, and then you do the 1031 exchange. So basically, I call it a business divorce. We're getting a business divorce. You don't get divorced overnight, right? So you gotta structure it. Dissolve this partnership. Property's gonna be all redeeded. New ownership. Now I don't own an interest in the company anymore. I own a direct interest in the real estate. So let's say it's a partner of 3. Okay, so now I own a third direct interest in the real estate versus a third of this company. And then I can do the 1031 exchange. And then Brian and Karen are gonna do they're gonna do a 1031 exchange. I'm gonna cash out and take my money and pay the taxes for it. Another version of it is gonna be the swap and drop, where you need the 1031 exchange first, and then drop out of the entity. But business divorces, it's just like a marriage divorce sometimes. It's sometimes not amicable. And so they're not gonna wait for you to like sell your property first and then do the 10. They're gonna, we want to get rid of it now. So the swap and drop is only when it's amicable. Let's say we're related, and then you're gonna go with me like, okay, we're just gonna do the 1031 exchange first, just to make things easier, and then we're gonna drop out of the partnership. The thing with the drop and swap, you always have to, tell your clients you have to be aware there's always risk of being audited, FRED. There are federal court cases that side with the drop and swap, so federally, the feds are okay with it based on the court cases that were challenged. Both versus News and Maloney were court cases that were challenged. The court sided with the taxpayer on that for the drop and swaps. Theoretically, between the time you do the drop and then the 1031 exchange, the more time in between, the better. Just because you have a new holding period of how long you own this property individually. Certain states, such as the California, the franchise tax board, I joke around the golden states, they're like the golden child, they're special. The state goes after you. They said, hey, we're the state, we're a franchise tax board, we don't really care about the Fed cases. We're state, so we're going to go after you for your taxes. If you've got clients in California, you're definitely talking to your CP, you're not going to do the 1031. And you're not doing a drop and swap. If you drop, you're going to have to hold it under your 10 common for quite a while before you do the 1031 exchange. You're not going to do it immediately. These are examples of like property. So I think I mentioned earlier, you go from farmland to single family house, probably under construction, oil, gas, mineral rights, commercial. These are all considered like kind. So you buy, as long as it's investment property.
You just said property under construction.
Correct.
So if I sold an existing house, purchased land, and am building another house, how do I show the 1031 amount that it's going to cost me to build a house?
So that's a different type of exchange. It's called an improvement exchange. So I'm going to go through it.
Okay.
Remember I mentioned typically you're going to do a direct deeded property that's going to be deeded from buyer to seller, seller to buyer. And then there's the sequential deeding. That means we're going to take title. Those are specific 1031 exchanges that we actually to part title, take ownership of the property for a while in order for you to complete the exchange. Residence does not qualify and the property does not qualify. Vacation homes were safe harbor. When the IRS safe harbor something, it's like you tag base. And if you tag base and you get tapped on, you're safe, right? So on vacation homes, if you follow their requirements, you're tagged safe, okay? And it's, I would say 2, 2, and 2 to remember it. 2, 2, and 2. The rules are the 2, 2, and 2. Hold it for 2 years, lease it out for 2 weeks of the year in the first 2 years. Then after that, and you want to limit your personal use to 2 weeks a year. And then after that, year 3 on, you've been safe harbored. You can definitely make it your second home, your primary residence, that's
So
fine.
this could be like an Airbnb type thing?
Yeah, you can, some people will lease out to a family member. It's like it's almost kind of like their private second home, so they'll lease out to a family member at fair market value. You want to show that on your docs, that you lease it out to fit the requirements. And then after that, you don't have to lease it out anymore. This is the exchange equation. For a full tax deferral, you want to reinvest all the net proceeds and have the same or greater debt. So I'm selling a property that's $900,000. My loan pay off is $300,000. My closing cost of sale is $60,000. So my net equity, my cash is $540,000. This is a straightforward exchange. I'm buying a replacement property for $1.2 million more. I've got more debt. My new loan is $660,000. So my net equity was all used. So this is a straightforward exchange. No boot. But on this other property here, I bought same property that I sold, but I'm replacing with a property that's less. $700,000 is what I'm buying for. My loan is less. It's $260,000. So I have a mortgage boot of $40,000. I took out $100,000 cash to spend, so therefore I have a cash boot of $100,000. So total boot is $140,000. I may have to pay taxes on $140,000 of boot. It's potential boot. You know why? I didn't tell you I'm a bad real estate investor. I have losses, right? My CPA said it's okay. We'll carry those losses forward and they'll offset it. So these things sometimes your clients will tell you, but sometimes clients will have losses that they can offset with their boot too. So CPAs will sometimes say it's okay to have boot. Always talk to your CPA. So these are the forms of the 1031 exchanges. The first two aren't really used. What you're going to use right now, most of the time you're going to do the delayed exchange with the qualified intermediary. That's selling the property and then buying the replacement property. The other ones, the reverse exchange, the improvement exchange, the reverse improvement exchange, we do those in parking arrangements where we have to park title. Now this is the process of the exchange. So Karen is going to buy, Karen's taxpayer, she's selling to Brian. So the property is going to be directly from Karen to Brian. And at closing, Brian pays me, I'm holding the funds as a qualified intermediary. Okay, so that's the day I collect the funds is when the time period starts. Karen has 180 days to close on the replacement property, but the first 45 days when she has to identify. So she's going to identify 3 properties. That's the most common rule. And then she's going to say, hey Cindy, of the 3 properties I identified, I'm only going to buy the 1. So she gives me the contract, and I use that contract to buy the replacement property, and that property is going to be directly deeded back to Karen. So that's the process of the 1031 exchange. That's what we do. We hold the funds during the exchange period. You can't touch the funds. That's a no-no. By the way, like the tax code, it used to be where we just swap properties, and there's no money involved. And eventually the IRS says, okay, Karen, you can sell to Brian and buy from the other person on a different day as long as you don't touch the proceeds. That's where we can't come in, because you are not allowed. It's no other rhyme or reason, just because the IRS says they said so.
Okay, so to clarify back on that, and just to verify, that clock starts at the closing of the first property, right?
Yeah, so the next day would be day 1.
Okay.
Yes.
So when you identify 3 properties, it doesn't matter how many doors those properties have. Like it could be one property could still be like an apartment complex
Correct.
that had or
Correct.
something else more complex maybe. But
Correct. Correct.
if it's one package, that's
Correct. So honestly, how I look at it is how many closing documents are there. So it could be like a portfolio of 10 houses, but
Okay.
under one contract. It's going to be one
That's one.
closing document.
okay.
Actually, no. There's several rules. I mean, for me, as far as numbers of closing, that's me. But as far as identifying, yeah, you would put a portfolio of whatever amount you want to identify as closely as possible.
So if it was like a block of townhouses.
Yeah.
That could
In
still be
that, in
one.
that big of a number, you may be looking at the 200% rule, in identification. I'll go through the rules, because there is rules to identifying, different rules that you use. The most common rule is identifying 3 properties. If you're buying a portfolio, you're not using a 3 property, you're probably using a different rule.
Okay.
So I saw this recently, I don't know if it's, you're able to do this, but actually on the listing, they wrote, seller is trying to do a 1031, so they're gonna push out the closing until they can identify 3 that they're actually gonna buy. Are we able to do that?
You can. I mean, that's just personal preference. Do you want to let people know that you're doing a 1031 exchange? Yeah. So let's say if you're on the buying side, you're buying a 1031 exchange property, and the seller knows, hey, you're 1031 exchange, or they can say, hey, we're not going to close, we're not giving you another 10 grand, because they know that you identified, only 5. Either you buy my property for another $10,000, or you pay your tax.
They know
I'm
you're
on the
under-
I'm on
they
the
know
seller
you're
side.
under-
So,
I'm on the
I
seller
mean,
side.
so contracts, it's good to have a language. If you have a brochure, the language is already in there. Buyer will participate, but it's not necessary. Contracts in Texas are assignable, so it's good to have a language, but it's not necessary. If you guys have a contract and it's going to be a 1031 exchange, you can add this language in special provisions, but it's not necessary. So,
Of course, with the new contracts, you don't got room to put that whole paragraph in there.
It's referenced in
Special
exhibit.
provisions.
do they have a thing to market on the new contract or no?
You'd have to do an exhibit A in that.
Yeah, they probably do an exhibit A then. So the 45 to 180 days are hard calendar days. You have midnight of the said day, the 45th day or the 180th day to close or to identify. Just remember the 180 day includes your tax extension. So there's no extension to these days unless it's a presidentially declared disaster, like our winter storm. There was an extension.
How do you prove that you identified it within 45 days? Is there,
Because we send you we give you a form that you fill out and you send it back to us. You can, there's rules to send it back, but you would send it back to us, we would sign off on it that we received it.
the
Qualified intermediary, or you can send it to the title company, but let's say you have your timestamp email, you can show, you can send it to your title company, but most people send it to us, because we're facilitating the exchange. So these are the identification rules. The most common rule is the 3 property rule, where you can identify 3, you can list 3 properties, and they can be at any price point. The second most common rule is the 200% rule. So if you want to identify more than 3 properties, you can, but it needs to be no more than 200% of the relinquished sales price. So if I sold for $500,000, I can identify more than 3 properties, but not be more than $1 million worth of property. So no more than 200% of the sales price. The third property rule is called the 95% rule, but it's technically 100%. It means you have to buy 95% of everything you identify. So, which means I identified 4 properties. 4 properties, can't use a 3 property rule, but 4 properties is 1.2 million. It's over the 200% rule. So therefore, to make it a valid exchange, it's got to be, you got to buy all 4 properties to make the exchange work, because you have to buy at least 95% of everything you identify, which is essentially 100% everything you identify. Identification needs to be in writing, unambiguously described, hand-delivered, mailed, telecopied, or otherwise sent. This is an old tax code. This is actually from the Treasury regulations. So who telecopies anymore, right? Sent in by midnight of the 45th day and delivered to the qualified intermediary or related party that's not disqualified. So that would be the title company. We had a client that was skiing. And then the realtor goes, hey, the property, it's your last day, you need to identify this property that came on the market. And our client was on the slopes, did not have any computer, so he took napkin, row. I identify this property as my replacement property for the 1031 exchange, address and all that stuff. Took a snapshot with his phone and then emailed it from his phone to us. And it kind of met all the criteria. Not the most professional way to identify it.
But then he's got to make sure he can actually get it under contract
Yes.
after the fact.
Yes. So the reverse exchange is going to be buying your replacement property first, and then selling your relinquished property. You have 180 days to complete that. The improvement exchange is after you sell your relinquished property, part of the proceeds will go buy the land, and then you're building the building. It's a build-to-suit or improvement, so it's a major capital renovation, or you're actually building the building. The reverse improvement exchange is essentially both. Being a client that had a feed store, and so she bought the building next door and made a major renovation to it. She needed to continue operating her business, and then she moved into that building and she sold. She had 180 days to sell it. So that's this. There's a little bit more complicated. Just call me if you have any questions. I know I'm talking a little too much on rushing through these, but you're not going to do this as often unless it's going to be a commercial property. It's more complicated, so it costs more to do. And that's been done since 2000. That was Safe Harbor 2000, so we've been doing that for 22 years. This is an important tax form that you have to fill out, Brian. You have to fill this out for 2022. Form 8824, it's going to ask you about your like-kind property. It's also going to ask you about a related party. Did you do an exchange with your related party? Who's your related party? Your parents, your children, your siblings are a related party. So there's rules around there. Okay, you cannot buy from a related party. You can sell to a related party, but not buy from a related party. Why? Because of tax evasion. Because I'm gonna buy my mom's property and then turn around and say, hey mom, that money that I gave you that I bought your farm from, you can have it back. You know, there's little games to be pulled, so I will try to do. So if you have questions on that, give me a call. Lastly, just to do your due diligence on your qualified intermediary. Okay, this is not a federally regulated industry, which means you want to trust the company. Make sure you use a reputable company. Of course, I'd like to be your resource. You want to know, the company you're using, are they creditworthy? What's their financial strength? Is the money going to be there to replace? Once we close on your property, I'm holding $500,000. Is the money going to be there for you to buy the new property? Do you have a trusting face? I do when I smile, right? Do we segregate accounts? We segregate accounts. Do we offer escrow? We offer escrow accounts. Do you want to pay for it? We offer those options. At the end of the day, our asset preservation is owned by, these are just the language for it. We are owned by Stewart Title. Stewart Title is a publicly traded title company. So Stewart Title gets a lot of assurance. Asset preservation, we're leading qualified intermediary. We've been around since 1990. The Treasury regulations came out in 1990. So it's been around, but it's evolved. The tax code's evolved. Treasury regulations came out in 1990. This is when API formed its company in 1990. Stewart Title bought us in 93 because we wanted a reputable title company to own us. And so when you use a company like ours, Stewart Title guarantees that the funds are going to be there for replacement. Okay, so if you don't use us, let's say it's out of your control and your client used someone else, it's good to know that I prefer you to use another qualified intermediary that's owned by another publicly traded title company. You want to have a security, right? Or maybe you think the money's going to be there, because being that it's not federally regulated, anyone can be a qualified intermediary. Your neighbor could be a qualified intermediary. So guess what happens? Sometimes they go bankrupt. because those funds, qualified, one of the smaller qualified intermediaries, this is a couple of years ago. Like, these bankruptcies are not like old, okay, they're past 10, 15 years, okay? A company in Nevada, they reinvested the funds in a rice augmentation company, and it went bankrupt. So I guess we'll have to pay clients money, you know, so you want to make sure, you know, are they reinvesting the funds, or are they just sitting there, you know? Security, there's I'm actually done with classes, kind of rambling on, but, so you have to go, I know some people snuck out, but, so there's if you have time, or you want to look this up, on YouTube, there's a show called American Greed. Have you heard of that show, American Greed? There's a whole episode on qualified intermediaries. Okay, so there's this guy in Florida, he owned real estate, but he wasn't cash flowing, so he came up with the genius idea. He bought